Hello, everyone. Welcome back to Muffet Investments. Today, we're tackling a hot topic, the economic wars between China and the West, their impact on global inflation, and how commodity prices and strategic minerals fit into the picture. If you haven't subscribed yet, please hit that subscribe button and like this video for more insightful analysis. The economic rivalry between China and the West has been intensifying over the past few years. This conflict involves various aspects, including trade wars, technological competition, and geopolitical tensions. These dynamics have significant implications for global markets and inflation. Before we dive into the details, we want to bring to your attention recent movements in commodity prices. These are the charts of copper, zinc, aluminum, silver, and iron ore. China's strategic objectives include both becoming a global superpower and achieving unification with Taiwan. These aims are intertwined and reflect the broader goals of the Chinese Communist Party, CCP, to solidify its power, expand its influence, and ensure national rejuvenation. Here is a detailed examination based on recent defense reports. National rejuvenation, the CCP's long-term goal, often referred to as the Great Rejuvenation of the Chinese nation, aims to restore China to a position of global prominence by 2049, the centenary of the founding of the People's Republic of China, PRC. Military modernization. Central to this ambition is the modernization of the People's Liberation Army, PLA, which aims to become a world-class military by 2049. This involves significant advancements in mechanization, informatization, and intelligentization, aimed at ensuring that the PLA can compete with or surpass the capabilities of other major world powers, particularly the United States. Global presence and influence. The PLA is expanding its global footprint through various means, including international military exercises, peacekeeping operations, and establishing overseas bases. This expansion is intended to secure China's overseas interests and project power, contributing to its status as a global superpower. Core national interest. Taiwan is considered a core national interest of China. The CCP views the unification of Taiwan with the mainland as crucial to national sovereignty and territorial integrity. The PLA has developed various strategies for this purpose, including the potential use of military force if necessary. China employs a range of economic strategies to assert its influence globally and counter Western dominance. These strategies are multifaceted, involving trade, investment, technology, and financial policies. Here are the key components of China's economic war strategies. Belt and Road Initiative, BRI. Global infrastructure investment. Launched in 2013, the BRI is China's ambitious global development strategy, involving infrastructure projects in over 140 countries. By financing and constructing roads, ports, railways, and other infrastructure, China aims to enhance global trade routes and increase its geopolitical influence. Debt diplomacy. Through the BRI, China often provides loans to developing countries, which can lead to significant debt burdens. This debt trap diplomacy allows China to exert political and economic leverage over these countries when they struggle to repay the loans. Technological advancement and decoupling. Made in China 2025, this initiative aims to transform China into a high-tech manufacturing powerhouse by 2025. The focus is on developing advanced technologies such as AI, robotics, and biotechnology, reducing dependence on foreign technology. Technological decoupling. In response to U.S. sanctions and trade restrictions, China is accelerating efforts to achieve self-sufficiency in critical technologies, particularly semiconductors. This includes substantial investments in domestic research and development, as well as acquiring foreign technology through mergers and acquisitions. Economic coercion. Trade sanctions and boycotts. China uses economic sanctions and consumer boycotts as tools of coercion against countries and companies that oppose its policies. For example, it has imposed trade restrictions on Australian products and orchestrated boycotts of South Korean businesses in response to political disputes. Market access as leverage. China often uses the promise of access to its vast market as a bargaining chip in negotiations, pushing foreign companies and governments to align with its interests. This leverage is particularly effective given China's position as the world's second-largest economy. Financial influence. Currency internationalization. China is actively promoting the use of its currency, the renminbi, RMB, in international trade and finance. This strategy aims to reduce dependence on the US dollar and increase China's influence over the global financial system. Sovereign wealth fund investments. Through entities like the China Investment Corporation, CIC, China invests heavily in foreign assets, including real estate, infrastructure, and technology. These investments help China secure strategic assets and influence foreign economies. Trade and investment agreements. Regional Comprehensive Economic Partnership, RCEP. China is a leading member of RCEP, the world's largest free trade agreement, which includes 15 Asia-Pacific countries. This agreement strengthens China's economic ties within the region and reduces reliance on Western markets. Bilateral investment treaties, BITs. China negotiates BITs to protect its overseas investments and ensure favorable conditions for Chinese companies operating abroad. These treaties also aim to attract foreign investment into China on terms that benefit its economic goals. China's economic war strategies are comprehensive and multidimensional, focusing on global infrastructure investment, technological advancement, economic coercion, financial influence, and strategic trade agreements. These strategies enable China to expand its global influence, secure strategic assets, and counteract Western economic dominance. The U.S.-China trade war, initiated during the Trump administration, aimed to address unfair trade practices and reduce the U.S.'s economic dependence on China. Tariffs were imposed on hundreds of billions of dollars worth of goods, leading to increased costs for businesses and consumers. While the tariffs intended to bring manufacturing back to the U.S., the immediate effect was a reduction in trade volumes and a reshuffling of global supply chains. The tariffs had varied effects on different sectors. For instance, industries heavily integrated with the Chinese market, like auto parts and IT hardware, faced significant challenges. Companies began considering relocating production to minimize risks. However, despite the trade war, China remains a crucial market for many multinational corporations due to its extensive supply networks and market size. Beyond trade, the U.S. and China are also locked in a fierce technological competition. The U.S. has imposed restrictions on Chinese tech giants and cut off access to critical technologies like semiconductors. This move aims to curb China's advancements in key areas such as AI and 5G, but it also creates supply chain disruptions and increases costs for tech products globally. So, how do these economic wars influence inflation? The disruptions in supply chains lead to higher production costs, which businesses often pass on to consumers. This situation has been exacerbated by the COVID-19 pandemic, which already strained global logistics. As a result, we've seen a significant rise in prices for goods and services. Central banks around the world, including the Federal Reserve and the European Central Bank, have been navigating these inflationary pressures by adjusting monetary policies. Interest rate hikes have been implemented to curb inflation, but this also slows economic growth and increases borrowing costs for businesses and consumers. Another critical aspect of the economic wars is the impact on commodity prices and strategic minerals. Commodities like oil, gas, and essential minerals such as lithium and cobalt have seen price volatility due to geopolitical tensions. China's dominance in the production of these critical minerals, especially rare earth elements, places it in a strategic position. This concentration can lead to price manipulation and supply disruptions, affecting industries globally. Strategic minerals are vital for various industries, including renewable energy and high-tech manufacturing. There is also a race to corner the market for key commodities such as copper, cobalt, nickel, and rare earth metals. The CCP also subsidizes Chinese companies to take out foreign competition, resulting in formation of monopolies in certain industries like steel. The Trump trade tariffs is a direct response to this. This, in our view, will cause commodity price rises, leading to inflation. The competition for these resources has intensified as countries strive to secure their supply chains. The global demand for these minerals is expected to rise significantly, further increasing their strategic importance and lead to rising commodity prices, which in turn lead to rising inflation. Looking ahead, the ongoing economic rivalry between China and the West will continue to shape global inflation and commodity prices. Inflation is likely to persist much longer than the central banks are currently predicting. The Western governments will use this to enforce financial repression and bring down their debt burden. Please watch our video on financial repression. Potential areas to watch include further technological decoupling, shifts in global supply chains, and the geopolitical landscape. It's crucial for investors to stay informed about these developments and their potential impacts on markets. In conclusion, the economic wars between China and the West are a significant driver of global inflation and market volatility. Understanding these dynamics is essential for making informed investment decisions. Thanks for watching. If you found this video helpful, please like, subscribe, and hit the bell icon for more updates. See you in the next video.